Good morning, everybody. Welcome to the Reserve Bank and to our March monetary policy statement. I'm Alan Bollard. The Reserve Bank today has decided to cut the official cash rate by 50 basis points to 3%. We have a picture of a world economy which deteriorated extremely rapidly last year, with financial losses and extreme volatility in place. We've since seen some substantial monetary policy and fiscal policy, orthodox and unorthodox responses from many countries, but we still expect negative economic forces to remain the dominant feature of this year, 2009. The timing and the extent of the recovery in the global economy is still extremely uncertain. In New Zealand, this has led to difficult trading conditions. We've seen a fall-off in export revenue, we've seen weak business sentiment, we've seen investment and employment dropping. We continue to see house prices falling, and households are pushing up precautionary savings quite significantly, and this adds up to quite a weak spending profile. Inflation, on the other hand, continues to abate in New Zealand. Well, we've cut the official cash rate by over 5% in just over 6 months, and that means that interest rates are now very stimulatory, and that's been a very big stimulation brought into place in a short period of time. There's more in the pipeline in the sense that we do expect to see further reductions in lending rates for businesses and households resulting from the cuts that we've already put in place. We note when we look at credit in the economy that credit growth is easing. This is in line with the weak economy in New Zealand, but we do expect banks to keep lending conservatively and appropriately in order to support the necessary recovery. As well as this big set of cuts in monetary policy, we've had now large stimulus from fiscal policy also. And those two, together with the significant exchange rate depreciation we've had, will work to help support the recovery in the New Zealand economy. We expect activity in New Zealand to trough around the middle of the year and then to gradually increase. But we do note it's a huge global crisis, and this does imply considerable uncertainty for the New Zealand forecasts. The New Zealand recovery, consequently, could be later or it could be slower. As the economy does trough, we note that we expect the rapid cuts we've seen in the monetary policy so far to slow down. Any future cuts are likely to be much smaller. We shouldn't expect to see anything like the near zero rates of some countries happening in New Zealand. We do need to retain competitiveness in international capital markets with our rates. Where will we go from here? Well, we will assess the need for any further reductions in the OCR by looking at developments in the global economy and developments in domestic economy as well. And we will also now be looking for signs of response to the policy loosening that has been in place for some time now. Thank you, ladies and gentlemen. That's the end of the formal part. We're happy to answer any questions. To assist me, I've got Dr. John McDermott, Assistant Governor and Head of Economics, and Tim Hampton, who is Head of the Forecasting Team. Are there any questions for us? Yes, thank you, and we'll ask you to take the microphone since we're webcasting.
Dr. Bollard, your recovery scenario is predicated on the, you say, extraordinary policy responses that other countries are taking, kind of doing the trick for our trading partners. How confident can you be about that? Have you got your fingers crossed behind your back a bit when you say that? Because there's not much evidence of it yet, is there?
No, it's been a very unusually deep and rugged set of turbulence in international economic and financial markets, and we've had to watch our colleagues in Northern Hemisphere, central banks, carrying out traditional monetary policies and fiscal policies, and then getting into unorthodox, and then getting into what Mervyn King, Governor of the Bank of England, has called unorthodox. So they're doing some quite radical things. We haven't had to go near that sort of space, but we're obviously watching very closely how successful they are in doing that. Difficult to judge that yet, because there's a lot of confidence in it, there's a lot of uncertainty in it, and the world hasn't been in this state with these possible monetary and sometimes fiscal policy tools available to them before.
Can you explain, Dr. Bollard, why our rate, I know you said it in the statement, but why it's so much higher than some other countries around the world?
Well, we're actually lower than Australia now, but we're still in the higher of the rates, and that partly reflects the fact that we've traditionally had higher rates and we came off a higher base. But more importantly, I think now it reflects the fact that the New Zealand economy, while clearly hit with this global shock, is actually in some ways in better position than those countries that have had to deal with very big and failing banking sectors, and more recently with very big export manufacturing sectors like East Asia. Those two regions have had it much harder than we have. In addition, they're finding a lot of trouble understanding where their housing sector is going to go. In the States and Britain, they still can't see a bottom to it. Our housing sector has been better behaved, and we haven't really changed our forecast very much on that. We're also aware of the fact that very low rates starts to hurt savers in New Zealand, and part of the recovery in all of this is going to have to see savings build up. We're already seeing some of this, but they're going to have to increase quite a lot, and we think they will. So we don't want unnecessarily to penalise savers. And of course, some of the people who invest in the New Zealand economy are foreigners and will also be looking for reasonable returns in that as well. Bear in mind, as we talk about these lower rates, that some of the investors will be looking at the real rates rather than the nominal rates, so they'll be taking inflation off there.
There's current bank deposit rates which almost double what the official cash rate now. So, I mean, savers aren't doing that badly at the moment.
Well, I'm getting a lot of letters from unhappy older people who are complaining about lower rates. The fact is they're probably getting better rates in New Zealand than in almost any other OECD country, but people who've relied on investment income for savings are getting hit at the moment.
And what would you say to people who do rely on term deposits to top up their incomes?
I wouldn't say anything particularly to them. Sorry, do you want to rephrase that question?
Well, just wondering, people that are relying on term deposits and the interest because that's dropped off, do you have any suggestions or any advice to those people?
Yeah, go and get a good advisor. That's always been our advice. At the very least, go to a good website like Sorted. Take advice on this, advice on how you structure income and wealth pulling out of the recession is just as important as getting advice during a period of higher possibilities and higher income.
And just quickly, do you think that banks have done enough to pass on rate cuts, not just in terms of mortgages, but in terms of credit card interest and business loans?
Well, we'll wait and see where they go with this cut. We don't think the cuts are finished yet by any means. We do note there's quite a bit in the pipeline. We have, until today, we had seen the official cash rate drop by just under 5%. We'd seen floating rates drop by just under 4%, and I think we'd seen two-year rates drop by just under 3%. The longer-term lending rates haven't dropped by as much, and that's basically because longer-term funding has been much more expensive and hard to get. So it becomes quite a tricky question depending on a bank's balance sheet. But, yeah, they're very aware of that, and we have seen some reasonable cuts coming through. Of course, it takes a while for them to come right through into the New Zealand economy because in the case of mortgages, there's probably, on average now, about a year that you have to wait to see the actual rate being reflected through in new mortgages.
Dr. Bollard, there was an unusually large range of expectations of what you would do today, possibly reflecting the uncertain times and so on. I think it ranged from some people thinking you might do nothing and others saying 100 basis points. Can you just talk us through why you opted for 50 basis points?
We opted for 50 basis points because we clearly thought we've still got a very weak situation and we still have time to put in place monetary policy changes which will be helpful in this cycle. We've been helped in all of this because we've been onto it reasonably early and got a lot of stimulus in place. We were more thinking about how do we manage the move towards the trough in interest rates, or the trough in the OCR, because as we're clearly signalling, we're not going to keep cutting forever, and actually we don't want to be in a position like the Federal Reserve or the Bank of England cutting to very, very low rates. So we're, if you like, cutting into a bit of a glide path on our OCR profile, and we're signalling that future rate cuts will be much less than this.
Just on another issue, Standard & Poor's has issued a warning saying they might downgrade New Zealand's credit rating, sovereign credit rating. Have you factored in a downgrade, and what do you assess as the chances that they will downgrade?
No, we haven't factored in a downgrade, but we've basically got a story which is reasonable recovery in relative terms, not bad compared to our trading partners and to other parts of the world. Of course, the uncertainty in our forecast is very much derivative of our uncertainty about whether the world economy troughs this year, which is the broad consensus view, or whether or not the more pessimistic view holds, which is the world economy continues to contract into next year and only then picks up. Were the latter to take place, then we'd have a difficult year ahead, showing through in things like operating balance and current account deficit, the sort of signals that rating agencies would look at. However, on our forecasts, we think they don't look benign, but they look controlled, and they're heading towards improvement, and the rating agencies understand that.
Dr. Ballard, what impact did the Australian decision to hold their rates have on you, and if any, was it because of the impact on the currency of a differential?
Well, it's good to have gutsy central banks around the region, but beyond that, no particular impact. We keep in touch with them to understand what's driving their forecast, particularly where there's common features. But we've made our own decision on this.
Dr. Bollard, you talk in the statement about a higher risk aversion around the currency. What's driving that?
I'm not sure if I did talk about higher risk aversion around the New Zealand currency. Oh, you mean in the statement, somewhere in the statement more broadly?
Yes.
Well, I mean, we're in a environment with a lot of volatility, a lot of vulnerability, and a lot of uncertainty around the real aggregates and the financial aggregates, and that's showing through on exchange rates around the world. And you'll have observed a period when overnight we've been seeing bad news in the US and US stock markets. It's almost become mechanical that the consequence of that is that the US dollar rises and the New Zealand, the Aussie and many other traded dollars go down. That's simply been a move towards world reserve currency under a stress situation. New Zealand is a small currency, small trading, and we'll always be awake to that. We don't forecast the exchange rate, but we do try and work out a useful projection, and our projection in here is that we do see a little further dropping away to 47 on the TWI, so as things are at the minute, roughly equivalent to 45 on the TWI, late this year?
Like the end of the year? Sorry.
By the end of this year, by late this year. That's been helpful to us, in that we're not particularly concerned about inflation at the minute, and it's making exports much more competitive and turning that current account deficit around much faster.
You forecast inflation back towards the middle of your target band. Why can't you cut the official cash rate more?
But we have just cut the official cash rate. You mean more?
50 basis points and closer to zero.
Well, the current program of existing cuts in the cash rate and those that are implied by where we have the 90-day interest rate track deliver the inflation CPI rate right in the middle of the track. It's currently going down a big fall, but that's basically a statistical feature of oil prices coming out. It then goes back into range and broadly then goes out to 2%, middle of the range. And that's, insofar as we're focused on anywhere, that's where we're focused.
Can you talk a bit more about this issue of competitiveness in the international markets? Is the current account deficit stopping you from cutting the official cash rate lower?
No, that's not been a big driver in our OCR decision. Tended to be more a driver when the New Zealand dollar was very high and there was a risk of us pushing it up even further or having an effect of pushing it up further by tightening. It's not the issue at the minute.
But you talk about the need to retain competitiveness in the international capital markets. Can you just elaborate on that a little bit then?
Sure, we're an externally funded economy like Australia, and external funders look for a return on their funding. So that is one of the things we need to think about. We're not just talking about demand for funds in all of this, we're talking about supply of funds as well. We've got to look at both sides. So this is effectively a price in the middle there, and we're saying a price near zero is not likely to be helpful.
Presumably New Zealand, if we did go down to near zero or zero, people wouldn't invest here because it basically a small country has a lot more risk than a larger economy.
Much less incentive to invest here. Yeah.
Dr. Bollard, could you run us through how this recession compares with previous ones?
Yeah, well, we internationally, it's pretty clear now that we're in the worst event since the 1930s. We've been saying that probably for some time, but we can say it with some authority now. The IMF is speculating that the world will contract this year, first time for a long time. The World Bank has said that they expect international trade to contract this year, first time since World War II. So it's a big event like that. It's a bit different from some previous events because the financial sectors have been much bigger, they've been much more of a catalyst, and they've been there to spread contagion a bit like a disease between markets much faster and more broad spread than we have seen in the other downturns, which I guess would be the early 80s, the late 80s, early 90s, the East Asia crisis and the tech wreck. So we're watching internationally worse numbers than in any of those events. We see them worse on financial markets, on spreads in financial markets, also on equity markets. We're seeing pretty much the same story back in New Zealand markets as well. So the sort of contraction that you've got in this picture, the negative output gap that you'll see on one of the graphs there is, I think, probably bigger than anything back to probably beyond the 80s.
It's pretty deep. I guess the other aspect is if you look at the New Zealand recession, the projection is for a total of 6 quarters of negative growth, which will make it the second longest New Zealand recession since the 1960s, the longest being in the late 1970s, mid to late 1970s.
Dr. Bollard, fundamentally this is a relatively optimistic scenario that you're painting in terms of a bounce back, both of the New Zealand economy this year and then of the international economy over the sort of 12 to 18 month horizon. And you're forecasting 4.1% US growth in 2010, both of which, on the face of it, given what you've just described, don't necessarily line up with everybody's expectations. Has any thought been put into having an alternative scenario or an alternative set of projections which model basically an alternative outcome that we basically don't have a recovery in the international markets?
Yeah, I'm just slightly surprised you would consider the worst recession since the 1930s as an optimistic scenario.
That's not what, I mean, your statement says 1970s, and he just said 6 quarters of negative growth, which is the worst one. And no, he's not. The statement doesn't say 1930s, and the numbers in your actual forecasts don't line up with that particularly.
One correction: we forecast the US to grow at 1% in
2010.
1%.
You're only
No,
forecasting
no,
a 2.5% negative growth this
The
year.
line above is Asia, which we project to grow 4% in that period.
Okay, well, you're also looking at 2.5% negative in the US, which is also, I mean, they did 2.5 negative in the last quarter, I think, didn't they? Or close to, or 1.7 or something. So, I mean, basically it looks optimistic. Is there been thought of looking at a more negative scenario?
Yeah, there has. I mean, this isn't optimistic, this is extremely pessimistic, but we do still hold to the basis that if things go down, they go up again. And the more they go down, the more there are some forces, there's more money around, there's more attractive prices, and as soon as there's confidence together, there will be rebound. One of the challenges we all face in doing this is some of the models can show that after a very nasty recession, you get quite a strong resurgent growth, perhaps only for a year or so, in recovery from that. But we don't have that in here. We've got a very fragile growth recovery in this. Yes, internally we will do further scenarios, and we'll look at what-if situations. We haven't done one, there isn't one for publication in here this time, but we'll play around with worse and better outcomes. We have said in this we think the risks are slightly to the downside of this, but not so far to the downside that we want to shift our forecast. This is our forecast.
Some people have talked about what they call an L-shaped recovery, which is what happened in the 30s.
I've heard L, J, V, W, and I've even heard of B. I don't know how B happens.
Well, that's as may be, but an L-shaped recovery is not a recovery essentially. So there's no bounce back, and that's what did happen in the 1930s. Eventually there was a brief bounce back about 3 or 4 years later, and then it went back into recession again. I mean, does that call for a totally different set of policy?
Yeah, if we were in the 1930s, you would get a totally different set of policies. But we're not convinced you have 1930s
situation
conditions
yet.
here.
So one.
You say you got very fragile growth, but the projection is for 4.6 or 4.8, depending which measure you take, in the March year to 2011.
What's that for?
For New Zealand growth.
Yeah.
We also reflect in the statement that there is a great deal of uncertainty around that projection, and it's very hard to predict the
central projection. 4.6 doesn't sound fragile.
The confidence interval around it is what we're talking about. There's a very wide range of possibilities.
Can I point you to figure 2.1 in the statement, which shows the current recovery relative to all the historical recoveries New Zealand's had, and this is by no means the strongest recovery.
We usually come out of these nasty recessionary events with a year of very strong growth. It doesn't persist.
Dr. Bollard, yesterday the Prime Minister complained that the New Zealand media was being negative about the state of the economy, and that he detected signs of what he called interesting signs in recovery. Do you share any of that optimism?
Well, we do at the first differential stage, sorry to be mathematical, but we are seeing a slowdown in the rate of new bad news.
Is that it? He pointed to tourism, but the figures in the monetary policy statement are quite sort of glaringly opposite to that.
There are some parts of the New Zealand economy that haven't been badly hit and are doing quite well. That comes through clearly in our business visits. If you look at some of the business opinion surveys, there's also some parts of those that don't look anything like as negative as what we're talking here. In addition, in relative terms, New Zealand and Australia aren't being hit, as commodity exporters aren't being hit as hard as those countries with big housing sectors in crisis, big banking sectors in crisis, and now big export manufacturing sectors in crisis. So we're better off in that sense, but that's a relative thing. We do think we're relatively advanced through this cycle, and we'll start to be looking fairly soon for this fragile recovery, but it is absolutely fragile. We haven't seen many early warning signs on that, and I know this morning we had yet another buoyant real estate agent set of commentaries, and they really need to wait till they've got a whole bunch of those before they start seeing a very good buying and selling environment.
So what's the risk if people think we've hit a trough and we haven't, the false recovery scenario?
Oh, well, the risk in any of this is that people don't understand where prices are going, and they're not in a position to make best quality investments that they would. That's been a real challenge over the last 4 years. It was a challenge when prices were high with oil prices. We saw all sorts of dumb investments out of that. that were clear when the prices came off. Now there's some risks that we're missing opportunities because prices are so low. And that's why we'll recover as soon as people in New Zealand can get a reasonably confirmed idea of where prices are going and some confidence that when they invest they'll actually be there.
Dr. Bollard, just on the current account deficit.
Could you shout out a bit,
yeah,
please?
On the current account deficit, are you saying if if the deficit got to much lower levels, are you saying that even if things got really bad, that the OCR would never get to zero or near zero in New Zealand because of this small country risk that we have?
Well, as we've said, we think that the effectiveness of the OCR, which we think has been very effective up till now, will start to decline as you start going into cuts that are really low, especially if it starts pushing you near a negative real interest rate. We have got a 90-day track that's consistent with the OCR troughing at around 2.5%. That doesn't cause us any particular concerns. Were the economy to have more bad news, it's not inconceivable that it could go lower, like 2%. But to go much below that, we think would be unlikely, unusual, and would have some undesirable effects.
Dr. Bollard, I'm just wondering whether you've noticed a change in attitude of the banks since the Job Summit.
Yeah, we've had a couple of conversations with the banks since then, and they, I think, in principle, well, we're somewhat surprised by some of the discussion at Job Summit, surprised that there was this build-up of angst in the corporate community about banks, have responded that what they were doing was putting in place tougher lending conditions that had actually already been signalled or were even there in legal documentation but had never been actually insisted on before, and have said, well, some New Zealand chief financial officers have got to get real about all of this. But despite all of that, they have also heard and I think reasserted the fact that they want to be here for New Zealand's recovery and they want to be part of it, and that does involve going out and getting extra funding as well as being open for sensible new business.
Dr. Bollard, are you concerned that the banks have yet to issue government-guaranteed wholesale debt internationally?
We know they've watched how the Australian government-guaranteed debt has gone with Australian parent banks, and there's a number of them either out there or very close to being out there to test it for New Zealand now. So we'll wait and watch the outcome of that.
And in the report you talk about bank margins increasing. Are you concerned that the banks are doing everything they can to play their part?
Oh, we certainly don't want to see bank margins building up unnecessarily. We can see some reason why they would at the longer end, but we do expect banks to be competitive through this period while being conservative and sensible. As we've said before, it hasn't been so much bank margins that have concerned us. It's more been any build-up in conditions, terms and conditions of lending that have tried to transfer effectively all the risk of lending onto the corporate in a way that's very difficult for the corporate to accept that. So we're more worried about those conditions and covenants than cuts in rates.
Do you think we need this co-investment fund that was talked about at the Job Summit?
I haven't got any comment on that.
Well, one of the other things that came up at the Job Summit was a discussion about aggregation of lending to local authorities. One of the Reserve Bank's powers is to lend to local authorities at attractive interest rates. Has there been any consideration of taking up that power and aggregating local authority funds and providing them to local authorities at low interest rates?
No.
Is there a reason why not?
We haven't felt it relevant at the minute, but we're very aware of our powers and we'll keep looking at them.
Is it a useful power, given you've expressed concerns at the last few monetary policy statements about rising rates? Clearly, if local authorities could get funding at more attractive rates, closer to the OCR, then that would have quite a significant effect on...
Well, our comment about rising rates was effectively they were putting the price of services to their ratepayers up, how you're finding other ways of funding that isn't actually going to cure it. It could make it worse.
We have lots of very indebted local authorities in New Zealand who, with accumulated debt of a very large amount of money. If the Reserve Bank was providing that funding, then the banks would presumably have funding available for lending to other people.
In principle, local authorities can go out to markets themselves, and they do.
Dr. Bollard, your projections of unemployment going to 6.8% seem relatively low given the kind of position that we're in. What makes you confident that it is not going to be much worse?
Probably a couple of things going on there. One is the idea that people over the past few years seem to have been working fewer hours on average. So to get the same number of hours of work, firms need to employ a large number of people. So at the margin, that's going to keep more people in jobs than would have otherwise been the case. The other thing is, during a downturn, when unemployment starts to pick up, you have more people returning to university or other forms of study, and so they although they're not working, they don't actually appear in the unemployment statistics, and so that participation rate, which has been trending up very strongly over the past few years in the strong economy, is expected to come down.
At the Job Summit, sorry to raise the keep on harping back to the Job Summit, but
you're going to have to shout out, Nigel.
The banks said that lending was increasing to businesses over the last 3 months of last year. Now, am I right in saying that the Reserve Bank figures on that show lending that is being drawn down currently, and hence, therefore, lending that's been agreed months previously? Do you have any sense of what new lending to business is doing at the moment? Is it being maintained at similar levels?
Yes, you're right in what you said. The lending figures for the corporate sector are quite strong. That does reflect commitments that have been reached previously that have been drawn down, some backfilling for finance company funding and so on. On new lending, yes, we do have some data. It looks like it's indicates reduced volumes, as you might expect at the minute. Part of that, of course, is driven by reduced demand for credit at the moment.
Can you say by how much it's reduced?
I haven't got the numbers on me, sorry.
Dr. Bollard, the Real Estate Institute seemed to see some signs of at least stability in the market with increasing volumes in the last month's figures. What are your projections in terms of house prices, and how do you see that housing market unfolding in the next 12 months?
Yeah, good to be optimistic. Well, we still think that there's quite a bit of house price reduction to go on, and that residential investment will remain weak for some time as well. So we've got residential investment still weakening through to halfway through this year, and then house prices continuing their fall through to the end of this year, a peak to trough fall of around 20%, which is roughly 25% in real terms. We then have fragile pickup, is that late next year? So we say not yet. Any other questions? Good, well, thank you for coming, everybody.